Okay, today we're going to be talking about capital gains and look at a very simplified example of how to calculate them and what the difference will be with the proposed changes for individuals. But before we begin, we need to go over four quick concepts that you need to understand before any of this is going to make sense. First of all, we'll begin by defining what is a capital gain. So, capital gains can be thought of as simply the profit you make on an investment. This could be stocks, bonds, and of course, real estate. So, if you buy something for $100 and you sell it for 200, you've made a profit or a capital gain of $100. Next, of course, the government wants to tax this profit, right? So, of course, right? This is called the capital gains tax. Now, since governments are very nice, they do not tax all of the capital gains, but only a portion of the gain. So this is key. It's only a portion of your profit that is being taxed, right? So this brings up our third concept called the inclusion rate. So if the government decides to only tax 50% of your capital gains, your inclusion rate is 50%. If they tax 60 of your profits, it's a 60% rate. So the rest is not taxed, right? This is key as well. So the rest is not taxed. The inclusion rates, by the way, not to get too far in the weeds here, but the inclusion rates are what governments change. So in 72, for example, it was 50% when introduced. Mulrooney brought it up to 75, and then it came back down to 50 under Chrétien. So the inclusion rate moving around, nothing new. The final point is to understand that there is no such thing as a capital gains tax rate. This confuses a lot of people who think that the government is trying to take 66% of their profits. Not at all the case. The portion of your profits that are taxed at your individual tax rate for that year. And this, of course, changes from individual to individual. So an NHL player will pay more taxes on that portion of their gain that is taxable than will somebody who's on a pension, for example. So to recap, a capital gain is a profit on an investment. The government only taxes a portion of that profit at the inclusion rate, and the actual tax rate you pay on that portion depends on you as an individual. So there's no such thing as a blanket capital gains tax rate. Okay, all right. So let's take a look at an example and put this all together in a very simple way and get you up to speed on capital gains. Okay, in our example, we're going to pretend that you bought a building 10 years ago for $1 million and you're selling it for $2.5 million in 2024. Congrats, good work. All right, first step is to figure out your capital gain. So here we see that your sale price of $2,500,000 minus your original purchase price of $1 million leaves you with a capital gain of $1.5 million. Nothing complicated here. And again, good work. The second step now is to figure out how much of that capital gain is taxable using the current 50% inclusion rate, and then figure out what the taxes actually are. So we're going to pretend, by the way, that your tax rate personal is 30%. So of the 1.5 million, only 50% is taxable, right? So this means that 750,000 gets taxed and the other 750 is not taxed. So we take the tax 750 and give the government 30% or 225,000. In a check, there are your taxes. Now with the new rules coming into effect June 25th, let's see how taxes change for our individual. So two things to keep in mind. Number one, for individuals, not corporations, but for individuals, the government is saying that the first 250,000 of capital gains are exempt from the increase to the new inclusion rate. And so they're going to stay at that 50%, right? But number two, all the money after that will be subject to the 66.67 inclusion rate. So not the old 50%. All right. So first 250,000, 50% is taxable. Everything after that, 2/3. Okay. So here's what that looks like. First thing we need to do is separate out the exemption from the total, right? So 1.5 million less 250,000 leaves 1,250,000, which we're going to call the remaining balance. So we start with the first 250K. We take 50% for taxable capital gains. And then we apply the 30% tax rate and send the government a check for 37,500. Now we have to apply the new inclusion rate of two-thirds, 66.67, to what we call the remaining balance to get 833,750 of taxable gains. Then we write a 30% check to the government for $250,125. So altogether, we are paying 287,625 in taxes under the new rules. Now let's see what the difference looks like. So under the old rules, you paid 225, and under the new rules, you will be on the hook for 287,625. So it's a $62,000 swing, wrong way, more taxes. Okay, so that is a very simplified example of capital gain calculation. It goes without saying that in the real world, it is a lot more complicated than this with depreciation, capital costs, and all the other things that make accountants so exciting. Regardless, I hope you found this useful. And as always, if you have any questions, I want to hear from you. So I've got my contacts in the description below. And if you made it this far, please consider taking 2 seconds for a like, subscribe. It's appreciated. Thanks for watching, and we'll talk soon.